Welcome to the deep dive. We're here to cut through the noise and get you straight to the core insights. Today, we are really diving deep into the half-year financials for a major life insurer. We're talking H1 FY26, the period ending September 30th, 2025. And these numbers were just approved, literally just signed off on October 15th. But, our mission here isn't just about the P&L headlines. We really want to understand the strategy behind the numbers. And critically, the big regulatory shifts impacting things, especially the recent changes to the goods and services tax, the GST in India, that seems huge.
Really is. And when you look at these results, the macro context is pretty interesting. You've got these global headwinds, sure, geopolitical stuff, uneven growth globally, but domestically, the Indian economy is showing, well, pretty strong resilience. So the company looks stable on the surface. But that stability, it kind of hides this massive strategic pivot they had to pull off because of that GST change.
Right, so it's like domestic strength running right into a major regulatory hurdle.
Exactly. The GST revision, it's a bit of a double-edged sword, structurally, long term. It's actually really constructive. You pass the tax benefit to the customer, insurance gets cheaper, more affordable, that helps penetration, big long-term win. But in the short term, taking away that input tax credit means the insurer suddenly has higher costs to absorb, instant pressure on their margins. That's the real tension here.
Okay. Let's start unpacking that. Maybe begin with the top-line performance. How did growth look overall?
Well, overall, growth was pretty solid, broadly met expectations, and importantly, they kept outperforming the rest of the private sector.
And the key metric there, the individual APE.
Right, individual annualized premium equivalent, APE, that grew 10% year on year. Now, maybe slightly slower than some really high benchmarks from the past, but if you look at the two-year CAGR, still a very healthy 20%, shows good underlying momentum.
Okay, 10% APE growth and total premiums.
Total premiums were up 15% year on year. That brought the total to 34,162 crore.
15%, that's substantial. But you mentioned something earlier about the existing customer base being key.
Absolutely. It's not just about new sales. Look at the renewal premium. That's the money coming in from policies sold in previous years. That grew even faster, actually, up 18% year on year, hitting 17,940 crore.
Wow, 18% on renewals. That really does signal a healthy, sticky customer base, doesn't it? High quality business.
Probably the most reliable indicator, yeah. High quality, long-term retention. And that strength, it fuels their market position. They actually gained market share, 90 basis points overall, pushing their total share up to 11.9%.
11.9% overall. And within the private sector, that's always super competitive.
Even there, they added 30 basis points, reached 16.6% market share among private insurers.
Given how big they already are, is gaining share like that still a big deal? Does it show they're pulling ahead?
Oh, definitely. At this kind of scale, every single basis point gain is tough. It really suggests their distribution engine is firing on all cylinders. They're converting market potential into sales, probably taking share from smaller players. And this scale, you also see it reflected in their balance sheet milestones.
Ah, yes, the assets under management, the AUM. That had a pretty big number, right?
Monumental, really. Their total AUM, and this includes their pension fund subsidiary, which is huge in its own right, officially crossed 5 trillion.
5 trillion rupees. That's quite something.
It is. It's not just a number. It cements them as a real institutional force in the market, capable of driving significant long-term investment returns. And just to put a finer point on it, the pension subsidiary, HDFC Pension Fund Management, its AUM got close to 1.4 lakh crore by September end.
Okay, staggering amounts. Now, drilling down into where the new sales growth is coming from, it looked like protection products were a real focus.
Absolutely. Retail protection APE, that grew 27% year on year.
27%. That's much faster than the overall company average.
Way faster. And strategically, that's vital. Protection products, things like term life, they're usually higher margin, and they're less tied to the ups and downs of the stock market compared to, say, investment-linked products. So it's a good quality growth area.
Right. Okay, so that covers scale and growth areas. Let's pivot now to profitability. This seems to be where that GST challenge really starts to complicate the picture. Profit after tax, the PAT, was up 9% year on year, hit 994 crore for the half. Looks solid enough on the surface?
It does. But the metrics that really tell you about future value, that's where you need to look close.
You mean the value of new business, VNB?
Exactly, VNB. Think of it as the present value of all the future profits expected from the new policies sold just in this half year. That grew 10% year on year, reaching up 1,818 crore, so growing in line with APE.
Okay, VNB up 10%. And linked right to that is the margin on that new business, the NBM.
Correct. New business margin, NBM. Basically, VNB as a percentage of APE. It tells you the profit margin on new sales. And that came in virtually flat, 24.5%, just a tiny dip from 24.6% in the same period last year, H1 FY25.
Hold on. Flat margin. That sounds, okay, stable maybe. But wait, didn't you say they were focusing more on higher margin protection products? And VNB grew. Why would the margin stay flat? Shouldn't it have gone up?
That is the million-dollar question, isn't it? Or perhaps the multi-crore question here. This is where you see just how big that GST impact was and how much heavy lifting they had to do internally to counteract it. The margin was directly hit by that withdrawal of the input tax credit under the new GST rules. Management actually stated it quite clearly. They said the NBM, before accounting for the GST hit, would have been 25%.
Okay, so 25% pre-GST down to 24.5% reported. That's a 0.5% hit, 50 basis points right there.
That's the net impact you see in the results, yes. But here's the really critical part. The estimated gross annualized impact of the GST change was much, much bigger. They figured it was around a 3% hit to NBM, 300 basis points, and it hits protection products particularly hard.
Whoa, wait a minute. If the gross hit was 3%, but the reported margin only fell by 0.1% compared to last year, or 0.5% compared to the pre-GST internal number, that means they managed to claw back almost the entire 3% hit through other actions, like 2.5% to 2.9% worth of margin improvement elsewhere, just in this first half.
That's exactly what it implies. It was a massive operational and strategic effort right out of the gate. They had to make immediate calculated shifts in product design, maybe pricing adjustments on some things, operational efficiencies, all to offset that huge headwind. So now the goal for the next, say, 2 or 3 quarters is to neutralize that remaining 0.5% drag and hopefully start pushing margins back up toward that 25% plus level again.
That is seriously impressive maneuvering. How exactly do they plan to keep doing that? What's the ongoing strategy to recover fully?
It's really a multi-pronged approach. There's no single silver bullet. Front, you've got continued focus on operational efficiency. Cost control. That includes having, let's say, some direct conversations with vendors and distributors. Remember, only about half of that input tax issue is apparently linked to sales commissions. The rest is other operational costs.
Okay, so cost control. What else?
Second, and this is key, a deliberate shift in the product mix.
What kind of shift are we talking about? Towards what?
Towards products that naturally carry higher margins. That means pushing ULIPs, the unit-linked insurance plans. But crucially, not just any ULIPs, they're focusing on ULIPs with higher sum assured multiples. This essentially beefs up the protection component within the ULIP, which tends to have better margins. They're also focusing on longer-term participating products, or PAR products.
But relying more on ULIPs even with higher protection, doesn't that bring in more market risk, exposes them more to equity market volatility?
It does. Absolutely. There's always that trade-off. But the strategy seems to be about these hybrid-type products. ULIPs with strong protection riders built in or added on. It's a balancing act. They need that potentially higher margin from the investment component to help offset the fixed cost hit from losing the input tax credit, especially on the pure protection side.
Okay, so product mix and hybrid designs. Anything else? New products?
Yes, new product innovation is definitely part of it. They mentioned they expect to launch a new variable annuity product. That's slated for the last quarter of this fiscal year, Q4 FY26. And the expectation is that this will be margin accretive, so it should help.
Right. But isn't the biggest lever they're pulling simply volume? The idea that because the GST change makes insurance cheaper for the customer, sales will just boom. And that sheer volume increase will compensate for the lower margin per policy.
That's a huge part of the bet, yes. They are counting on that long-term structural tailwind of affordability kicking in. Making insurance cheaper should, theoretically, drive much higher penetration and volume over time. And the early signs, well, they seem promising. They specifically mentioned that retail protection growth after the GST changes kicked in was apparently running at more than 50% in the single month of September alone.
50% growth in a month, that's incredibly aggressive volume. Okay. Let's shift gears slightly now. Let's look at the balance sheet strength and how they're reaching these customers. Capital adequacy first, the solvency ratio. That saw a bit of a dip, didn't it? Down to 175%.
It did. It was down from 192% back in June 2025 and 181% a year ago in H1 FY25. Now, 175% is still comfortably above the regulatory minimum, so it wasn't a crisis situation. But yeah, it's a noticeable drop and needs watching.
What drove that drop? Was it just one thing?
No. It was a combination of factors hitting around the same time. You had the planned dividend payout to shareholders. Then they repaid 600 crore of subordinated debt during the second quarter, Q2. And importantly, the sheer growth in protection business causes what's called strain on capital.
Right, strain. Can you quickly explain what that means in this context for listeners who might not be familiar?
Sure, when an insurer sells a protection policy, like term life insurance, regulations require them to set aside a significant chunk of capital immediately, right up front. This is to cover the potential future claim, even though they've only received a small premium payment so far. This upfront capital requirement is the strain. So paradoxically, selling a lot of high-margin protection business actually consumes capital quite rapidly in the short term.
Okay, got it. So dividend, debt repayment, and strain from growing the protection book. Did the GST factor play into the solvency drop as well?
It did, yeah. That GST impact, the loss of the input tax credit, also had a direct hit on the capital position. Management estimated it accounted for about 150 basis points, or 1.5%, of that total drop in the solvency ratio. So it compounded the other factors.
Okay, quite a few moving parts pulling it down. So what's the plan to shore it back up, to reinforce that capital buffer?
Well, management seems comfortable operating in a range of about 170% to 185% solvency. That's their target zone. To make sure they stay comfortably within that and probably push towards the upper end, the board has given in-principle approval to raise more capital. They're looking to raise up to 750 crore through non-convertible debentures and CDs, basically, issuing debt in the second half of this fiscal year. This is planned as subordinated debt, and they expect it to boost the solvency ratio by about 7 percentage points.
Okay, so raising 750 crore via NCDs should add about 7%, bringing them from 175% back up to around 182%, right back into that comfort zone. Makes sense. Now let's look at where all these new policies are actually coming from, their distribution reach. The focus seems to be shifting, right, away from just the big metros.
Oh, absolutely. That's probably the defining feature of their current growth strategy, the Tier 2 and Tier 3 cities, the non-metro markets. Growth in those areas was significantly faster than in the Tier 1 cities. And get this, those Tier 23 markets were responsible for roughly three-quarters, 75% of all the new policies sold in this first half.
Three-quarters of new policies from outside the major cities, that's a huge shift. That must require a massive expansion of their sales force in those areas.
Exactly. You need feet on the street, or rather, agents in the towns and villages. And the numbers back it up. They onboarded over 51,000 new agents just in H1 FY26, and a staggering 80% of those new agents came from those Tier 2 and Tier 3 geographies. That agent growth is the engine driving that deep market penetration.
51,000 new agents, mostly outside metros. That's rapid expansion. Okay, finally, let's quickly check on persistency. This tells us if the policies being sold are actually sticking, right? Quality check.
Right. It measures how many customers keep paying their premiums over time, and the long-term picture looks pretty good. The 61st month persistency that's policies staying active after 5 years was stable at 62%, actually up a bit from 60% last year. Shows the older book is solid.
5-year persistency is good. What about earlier on?
That's where there was a slight dip. The 13th month persistency policies active after just 1 year, it slipped slightly, down to 86% from 88% last year.
86% down from 88%. That 2-point drop. Does that suggest maybe the very rapid growth in those Tier 23 markets with all those new agents? Maybe those policies are smaller ticket sizes or perhaps just need a bit more follow-up initially to ensure they stick?
That's likely the dynamic, yes. It highlights that short-term pressure. When you're onboarding agents that quickly and selling so many new policies in newer, faster-growing markets, you're naturally going to see a bit of volatility in those early retention numbers. It's almost a trade-off for that kind of high-speed, geographically deep growth. The key for them going forward will be strong training, quality control, and customer engagement processes within those newer agencies. That'll be paramount.
Okay, so let's try and pull all these threads together. What's the big picture here? What does this half-year performance really tell us?
Well, if you connect the dots, H1 FY26 was fundamentally about successfully navigating a major regulatory shock, the GST change, while simultaneously executing a really aggressive expansion plan. They effectively passed the test, they absorbed a potential 3% gross margin hit, managed to keep overall growth going, and largely stabilized the reported margins through those quick operational and product mix changes. They seem to have accepted some short-term consequences like the temporary dip in the solvency ratio before the capital raise and that slight tick down in early persistency. They traded that essentially for the bigger long-term prize, leveraging the increased affordability from the GST change to drive deeper market penetration, especially outside the big cities. It really reaffirms their underlying confidence that India's growing need for insurance, particularly protection, is the powerful structural tailwind that will ultimately drive value.
That is a really complex picture, but it sounds like a sophisticated recovery and growth plan. So for you, the listener, as you're processing all this, it seems the company is really banking on two things now: driving huge volumes, especially from those tier 2 and tier 3 markets, fueled by lower prices post GST, and pushing higher margin features, like in those enhanced ULIPs and PAR products, to offset the remaining cost pressures. The big question, the challenge for the second half of this fiscal year, seems to be managing the inherent tension in that strategy. How effectively can they keep chasing that massive volume, which naturally puts some pressure on things like early policy quality and capital strain, while also maintaining the sharp focus and discipline needed to actually realize those higher product margins? It feels like walking a tightrope.
It absolutely is. It's a high-stakes balancing act between aggressive market expansion and careful profitability refinement. Very tricky to get right.
We'll certainly be keeping a close eye on how that tension plays out in the next set of results. That concludes this deep dive into the H1 FY26 results. We hope you feel thoroughly informed and have plenty to think about.